Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Payroll data remains noisy and is, of course, backward-looking, but leading indicators from small businesses are taking a leg up. That matters because small business hiring has historically led shifts in the job market. At the same time, the Fed looks supportive, but maybe not reactive, a backdrop that's often been constructive for markets. Our next guest says this combination could mean that 2026 looks better than investors expect, particularly for undervalued sectors like financials. So does this shift change how we should be thinking about jobs, rates, and sector opportunities? Joining us here today to walk us through what data might really be saying and we need to be listening to is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Warm welcome to you, Denise. How are you?
Hey, I'm very well. Excited for the holiday season.
It's around the corner. It's wonderful to see you, probably this last time in Fidelity Connects before the new year, so we'll have you help us wrap things up. I mean, there's been a lot of data out this week, but here we go with the inflation numbers in the U.S. Final count before the next Fed decision. Looks okay.
Yeah, looks better than we thought, right? So coming into the year, it's interesting. The median dot from the Fed on inflation was 2.8%, right? So this is core inflation. And core inflation just came in on a year-on-year basis at 2.6. So it's interesting, despite the fact that we saw tariffs, obviously, in mid-year and Liberation Day, and yet there was no change in the deceleration. Now, there is some angst over whether or not this is distorted and there was enough of a sample size. So we'll certainly have to see in revisions. But if you look at the data, it looks like, it's all kind of on trend. So it's the ultimate irony, I think, in the market that despite the fact that some of the prices in the CPI went up as a result of tariffs, we have seen a top quartile deceleration in inflation over the last year. And the 25% of the time that happens, when you look out over the next year, what does that monotonically lead to? Usually higher stock prices, led by those economically sensitive sectors like technology, consumer discretionary, and financials, where defensive sectors tend to lag, which is exactly what we saw this year, which I do think looks very, very likely based on the inflation data and all the other data we can talk about, looks likely to repeat into 2026.
So you're too elegant to say, I told you so, but I'm going to say it for you, that you have been saying that this is likely the direction that inflation is going for a very long time. I mean, months, we go back to last year even, and when the rate cutting cycle began back at September 2024. However, there have been many, many voices and noisiness within this, but you sort of quite clearly said it looks like it's on track for continuing deceleration, and here we are. I wonder if you can just remind us a little bit about what you saw months ago.
Yeah, well, it's not really me. I mean, it's in the historic data. When you look at every time we've instituted tariffs, you have seen a deceleration in inflation, which means that if you think about the logic of it, and hold everything else constant, it's true. Some prices will go up. The question is, will those prices going up infect all of the broader prices, and will you see a broader acceleration? And the answer to that historically is no. And I think the answer is more like what we've talked about over the last couple months, which is tariffs act like a tax. So if you pay more for one set of goods, then you don't have the money to pay for the other set of goods. And therefore, that marginal propensity to consume declines, and the pricing power that corporate America ultimately sees declines as well. So it doesn't really distort the overall trend. Again, I think that always the message for investors is, as much as, look, it is fun to do sort of hold else equal and see which parts move and which parts are meaningful. But the more you do that, the more I think that you sort of blur the lines in terms of what the actual signal is. And yes, did it raise some prices? Absolutely. Will it raise all prices and change the trend? What you've seen historically is no. So it's not really me. It's more that I think that the data in history is usually throwing the correct cautionary flags to investors over, wait, don't hold all else equal. Let's look to see if this has been a significant variable. And history can show you more often than not, some of the things that you think are very significant aren't at all.
So fascinating. So even before today, the couple of things that were giving an outlook for 2026 in your mind really were sort of the rate story ultimately. Mm-hmm. And tell us what you've been seeing in job growth. There's sort of a couple of things that go together that, again, come back to a bit of a durable recovery, I think, as you've always put it. But what was lining up even before today's numbers for 2026?
Yeah, we've talked about the fact that jobs are a lagging indicator. So if you're thinking about what do I think about the job market, and then should I use that in my investment thesis to add to equities or subtract from equities, you can be led astray, meaning that bad payroll reports usually beget good market conditions because the stock market has already discounted it. And as frustrating as that is, that happens over and over again through time. But when you think about that, I think it's important to put together the leading indicators, why that could be wrong. We've talked about other leading indicators in terms of CEO confidence and the fact that median earnings are now finally joining the party after the better part of 3 years. And now we have a confirming signal in the small business survey. And that's really important because as much as small businesses are only one portion of jobs and most people are employed by larger companies, they actually move the needle quite a bit on the marginal employment. And more importantly, they have been the laggards this cycle.
Right.
So small businesses, at least according to ADP, is likely in contractionary territory, while large businesses are still hiring. So it now looks like we are seeing the small business survey say, hey, all of a sudden my intentions to hire over the course of the next year are higher. We've seen a top decile move in that inflection. Again, looking back to those historic relationships, where's their signal, where's their noise? You're finding signal, the bigger the acceleration in that intention to hire, the more likely it is that the unemployment rate is lower or the job growth is higher. So I'm not saying that the unemployment rate is going to go down necessarily. I do think that we're in a complicated cycle that I still call off cycle. We had a full, what I would call a full employment recession in 2022, and now we're having a full employment recovery. So it's not going to feel like other, quote, recoveries because not a lot of people lost their jobs. It would be different if corporate America actually laid off in 2022, but they didn't. So we're in a better position in terms of the durability of jobs, but it's not going to grow strongly. But when you look out in 2026, if you're angsty about whether or not jobs are going to be better into 2026, or that we are just going to continue this slow slide and maybe into a recession, or maybe we have already even been in one, and BER might look back and say that there was actually a contraction. But it looks to me like the data suggests that it's actually going to be better into 2026. And you have the Fed on your side, which raises the odds that NFIB or the small businesses will higher in the future. You also now see them more profitable than they've been. And when the two are combined, you actually have 70 to 75% odds that you will see payroll growth in small businesses over the course of the next year, which is now being confirmed in the survey. So I think we have a nice sort of statistical bow, which is of course not perfection. I can't obviously guarantee you that there will be employment growth, but it does look like a lot of things are stacking up on one side to suggest it's better, not worse, into 2026.
And one of the other sort of reasons for things stacking up, or I'd ask you to put it into context, is the rate environment. So we've had this cut from the Fed. In theory, small businesses, when rates come down, and there's also been some wonkiness with rates actually coming down for those businesses to borrow at lower rates. But it looks like there is a landing for that to happen, for them to borrow and therefore hire ultimately because they're expanding.
No, that's exactly right. And in that survey, in the NFIB or small business survey, you see that the rate that they are showing the survey that they are borrowing at is finally starting to come down. And that wasn't, to your point, up until this point. So, and it gets back to something that we've always talked about, which is the Fed cutting is important, but it's more important that they're cutting because they can, not because they have to. So in that environment, that's usually negative for small businesses, and in some ways, any businesses, if they're cutting because they have to. They're usually sort of following the cycle, not necessarily creating the cycle. So to the extent that inflation is coming in lower than we expected, even after tariffs, then the Fed can continue to normalize policy lower, and maybe we're going to see one or maybe two cuts next year after the 3 cuts that we've seen this year, and that translation mechanism will translate into the durability of employment growth and the durability of profit growth into 2026, which I think is sort of the definition and the underpinning of the secular bull market that looks likely to continue.
So we'll go into some of the sectors that are perhaps more of interest or less of interest, but that durability comes back to this sort of discussion of the everything else trade for U.S. stocks other than the hyperscalers, essentially. And this fits into that. I mean, this is one of the underpinnings of everything else.
I think that's right. So the one thing that I would say is I've been a big sort of I've said before that I do think that the market is going to broaden. I think that there are many strategists that think it's going to rotate, meaning that you need to sell your technology stocks and buy the other, 493 or buy every other sector. That part, I'm not there. I think that technology looks like durable leadership to me. I think that their fundamental underpinning of future earnings growth is very, very strong, and valuation does not dissuade me because it has not been historically predictive. Now, that said, when you look at sort of the sector map, and I don't know exactly where we are today, but as of last, I think Wednesday, technology and communication services were the only two sectors that were actually beating the S&P 500. I expect it to be more broad than that into 2026. And I do think that there's been some broadening points throughout the year in 2025. So it hasn't been, just a technology market the entire year. I think that there was some shape shifting along the way, and I think that there will be more shape shifting. The question that I get all the time is, well, where is the second best place to look? And for me, the interesting part is now, again, re-ranking the three sectors that I'm continually talking about where I see opportunities, and I have seen opportunities over the last couple of years: technology, consumer discretionary, and financials. I think financials has taken a couple clicks up yet again. Here's the reason behind that. Financials in the Russell 3000, and I didn't look in the S&P 500, but I was just doing a deep dive on the data, and this note will come out in a couple weeks. So I worked on it, but then tomorrow's note is going to be on inflation, so I wanted to get that out. But in a couple of weeks, you'll see the note on financials. And the interesting part is, in the Russell 3000, 3 out of the 4 last years, financials actually outperformed. Right, so they have outperformed, and in the bulk of the first quarter, they've outperformed. But if you look over really the last 4 years, they've essentially been dead money. So it's almost like been a trading range, and when they get sort of too high, you maybe potentially want to sell them, and then when they get too low, they usually provide an opportunity. What I see in the data is entirely reflective of almost exactly that, which is to say that valuation, when they get to bottom decile levels, really does have a very strong risk reward, and it's been true in every 5-year increment, even since the financial crisis. So I think valuation shows you a really, really strong risk reward. So I do think, yes, financials have gone nowhere. So you could certainly say, well, Denise, you weren't right. There wasn't a lot of upside, but there also wasn't a lot of downside either. So for me, that seems like it's a really strong call option on a continual basis. Can I guarantee you that you're going to see something like tech performance? No, but I do think it's a really good spot to park a lot of capital, given that minimal downside risk that I see statistically in the data supported by valuations. So just over the past couple of months, earnings have been strong, the stocks have been weak, we're back down to bottom decile valuations. I think whenever you see that, you have to sort of take it a couple clicks up and park some capital in financials. And the interesting part is, when you look historically, that's been a really strong negative correlation with the technology sector. Now look, don't confuse negative correlations with the fact that, if technology outperforms, financials have to underperform. The correlation I'm talking about is just the slope of the line. So in the last, I think, 8 years that technology has outperformed, which is most of the time, financials have actually outperformed 4 of those years. So again, it's not exactly negative, it's just the slope of the lines. But when you look on a go-forward basis, when you're coming from this negative 0.8 correlation, you usually do see, over the course of the next year, both sectors outperform together. And I think that negative correlation is almost like a measure of fear for financials, like, oh, this is not going well. And I think that provides investors an opportunity to actually add to positions to protect in terms of downside. And you always have the call option of, look, maybe deregulation will stimulate earnings growth, and maybe you'll finally get some valuation expansion along with the durable earnings growth that we've already seen. So financials, as we approach 2026, look to be even more interesting. They always seem like a little bit more interesting at the end of the year for that first quarter pop. But again, I do think that it's kind of durable from that perspective. I think that you want to own financials as a sector because the downside is fairly limited when valuations get to these levels. So if you're looking for a negative corollary to technology stocks, I think it's an opportunity.
That's fascinating. And then where does, no, amazing. And therefore, consumer discretionary fits where? Would you say now number 3?
Number three.
Number three. Okay, they've
Rate
kind of
sensitive
switched.
for sure.
Yes,
But
that's what I was
less,
gonna ask.
ironically, less rate sensitive than technology. And that's partly around the fact that technology has had a better secular margin trend. So whenever you see disinflation, or I wouldn't call it deflation, but disinflationary trend, you usually get multiple expansion. You get multiple expansion most in the place where there is strong profitability. And that has been more technology than it is consumer discretionary. So at this point, when you look at a disinflationary trend and you say rates coming down, that's actually better for technology stocks than it is for consumer discretionary. But look, we talked about home builders months ago, and they've either gone nowhere or underperformed. I still think that they're an opportunity.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
It's fascinating. So you mentioned consolidation. It's sort of like they're on the side, they're fries on the side. But so what you mentioned is the case for it. But deregulation, there's a rate cycle going on as well, which, I mean, you used to argue that higher rates can help the banks out because they can charge more for their loans. So I was just going to ask about those two macro things, the consolidation potential because of deregulation and the rate story for banks/financials broadly.
I think when you look at the rate story, because of the corollary between rates and growth, it does sort of muddy the waters. Do I want higher rates? Do I want lower rates? When you look at it statistically, you want a steepening yield curve.
Okay.
So that is more or less, I think, what's predictive of the banks. And when you look, when you actually get Fed cuts, you get 75% odds that the yield curve does tend to steepen. And that's back on the, wait a minute, I don't understand. So if the Fed's cutting, you mean the 10-year goes up and that's a good thing? It can be for banks because they borrow short and lend long. So that has been a better setup for them historically. Now we're only, I think, when you look at the 3-month versus the 10-year, I think we're only at 50 basis points. When the peak, yield curve has been 150 to 250 basis points when you look at the range. So we're nowhere in terms of steepness, but if you saw something like more rate cuts and more growth along with it, you would get a steeper yield curve, which is beneficial for the banks. So I think that that's what you want to keep your eye on. We did have a steepening trend when the rate cycle started, and it's been flattened out year to date. Wouldn't surprise me if that steepening trend picks back up into 2026. And as to your point on consolidation and better profitability associated with that consolidation, which you would expect, I think that that's all a call option. Would I say that you would need to bet on it? I would say that the valuation data that I'm looking at says you don't have to bet on it, but if it comes to fruition, that means either the stocks are even cheaper because they're going to be more profitable, or earnings growth is going to be more durable than you expect because deregulation.
Fascinating how those fit into it, but are not necessarily the base case for it. They're sort of the extras. Take us through the discussion of, so productivity is a little bit of a nebulous term. We know ultimately it means good things and it means an economy is more efficient ultimately. We're also hearing the term AI used by central bankers around the world. This morning, Christine Lagarde in ECB comments was mentioning AI and the good things that it's going to do for Europe ultimately. This is being sprinkled through Fed speak. I don't know to what extent that's the most useful thing to unpack, or just the productivity, if you can take us there, because we all know it's good for us. We all know there's lots of different ways to measure it. What might you point us in the direction of to watch for on this front if it's so hard to measure?
Yeah, I think when you look at productivity cycles over time, like the boom time that people usually talk about is the late 90s, when productivity growth as measured by the Fed, which is both labor and capital, was growing above, I want to say, I think 4%, which means that you can have higher growth with lower inflation because you are more productive per worker and per capital use. I think there's a lot of optimism around AI. We'll see. I don't think that it's been in the data yet. We'll see how that evolves. But I think when we break it down and say, okay, let's talk specifically about labor productivity,
right?
There seems to be angst that we do not have enough labor supply potentially in the United States to fuel our growth. And when you look at that over time, I mean, this is not exactly productivity as they measure it in terms of labor productivity, but if we're breaking it down to say, how can I make sense of this and how can I understand it as a consumer of economic data and then translate it to what I think about stocks and what I think about the economy going forward, labor force was flat pretty much, for the last 25 years before COVID, right? So 00 to essentially 2020, there was almost zero labor force growth and GDP grew the entire time. Now, look, it wasn't particularly productive. It wasn't 1990 style productive. But I think that the angst around, well, what if the labor force doesn't grow? Is this a problem either that means that we can't grow? Well, that would refute that. Or I think more importantly, if the labor force doesn't grow, does that mean at the already low unemployment rate that we are going to see a wage price spiral and wages will spike? And I think that that is erroneous as well, because the unemployment rate has very little correlation to wage growth, which is why you see right now we have a very low unemployment rate, but wage growth is decelerating. So in some ways, the deceleration in wages is telling you you need less supply to actually have positive real wage growth. So I'm not necessarily sure that a declining supply in terms of labor growth would lead to wage inflation so much as it would probably lead to a wage stabilization that we actually need. It's a little bit like OPEC and oil prices.
Okay. I'm not sure I understand that comparison. I'll ask you about that. Okay. Yeah.
Yeah. Okay.
But I was just going to say.
Yeah. No. So I think there are people who say, okay, well, the Permian is shutting in production. That means that, oil prices are going to spike because people are declining supply. No, that's what they need to do.
They need
to stabilize pricing.
Right. So on the supply question, because it's certainly a political hot potato, the where people are coming from and not coming from and so on, and are there enough people left for jobs? But as you say, I mean, one of the things we also heard from central banks recently is that it was sort of a tough medicine. Prices are not coming down. Like the grocery store is not going to get cheaper. It's just not. And therefore, prices will remain. And what will ultimately happen within the economy if central banks and lots of other entities come together is people will earn more to catch up to those high prices at the grocery store, for instance. But to do that, you need some scarcity in the labor supply. Is that right?
No, I think that's exactly right. Well put together. Yes, I think that that's exactly right. The best way to solve the affordability crisis is actually through time. You really don't want to solve it through price, right? The Federal Reserve could hike rates to 10%. We could go into a depression, and that would solve your pricing problem, but it would create a whole lot of other problems. And it wouldn't solve purchasing power, which is what you want. So what's the best way to solve purchasing power? Make the economic expansion durable. And that's going to take some time. So the affordability problem is not going to be solved in 2026. It might not even be solved by 2028. But if income grows over time and you restrict supply to allow wages to grow over time, it will eventually solve itself.
Amazing. There's a couple of great questions here. So to go back to financials, which you were talking about.
Yeah.
Are there financial subsectors that are more interesting than others? You mentioned the banks, but obviously it's a big sector.
Yeah, so financials overall is interesting because they have bottom decile valuation, but they have above 50%, the 50th percentile ROEs. Banks are a little bit different. They're definitely bottom decile valuation, but they're not quite above your usual profitability. So I do think that puts them in more the trade, not secular hold. Okay. Capital markets and brokers and all of those sort of tied to what I would call the market cycle, that tends to look better over time. You have valuation on your side. Yes, definitely not as cheap as banks, but the returns and the operating margins and the structural fundamentals of the businesses have been better secularly. So I still see that as an opportunity, which is not to say that at this point, I do think banks got back down to bottom decile valuations. So I think that there's a good opportunity for capital there, but I usually tend to add to things like brokers and capital markets as well.
Okay, fantastic. Asking if you can speak to a little bit of a comparison. This isn't always your wheelhouse that you're happy with, but the question is about U.S. stock valuations versus the global markets, Europe and Japan as examples. Yeah.
We're expensive, they're cheap, and that has not been predictive historically. What you have seen is a structural de-rating outside the U.S. because there is less earnings growth cycle to cycle outside the U.S. So I do think that this was an opportunity, if you own international stocks, to trim that position going in. Because what we're seeing right now is technology and the US stock market overall has re-accelerated to top quartile earnings growth at the same time where everybody outside the United States is decelerating again in terms of earnings growth. Might it be different this time because Europe is investing in defense? Maybe. But so far, we are not seeing that in the data. I'm not seeing any difference in terms of the differential between the median US company and the median European company to suggest that is the case. So if that's not the case going forward, then what you would expect from a historical perspective is to see continued derating between outside the US and the US. So I think that US leadership is intact for 2026.
So if stocks follow earnings and earnings are perhaps done what they can do globally, it goes down the other side potentially.
Right, that's exactly right.
Let's finish off with a couple of thoughts just on inflation. It's what you're going to write your paper on for tomorrow. It's the numbers that we got out today. Essentially, what the Fed has to, not to make it too playful, but to play with ultimately. Like they don't have to, you can sort of imagine Jay Powell going, phew, last,
call that
one
one
less
right.
thing. Yeah, exactly. So implications for the Fed and central banks and really the story for the economy based on this inflation report, if we can just kind of finish out that way.
Yeah, there was a lot of angst over will the Fed have the will to potentially resist an administration that is either demanding lower rates? And now I think that whole conversation, I don't want to say it goes away, but it's definitely dramatically lessened because the data supports the Fed cutting rates. Inflation is coming in lower than they expected and may continue the deceleration as we enter 2026, which means that the Federal Reserve can, on the data, lower the rates because they can. Not because anybody's asking them to, not because anybody's demanding that they do, just because they can based on the data.
Fantastic. We wish you a lovely holiday season with your family, and we look forward to seeing you in the new year. Denise Chisholm, thank you for sharing your thoughts and data and interpretations with us.
Yeah, great to be here all year. I'll see you next year.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.